After a long, distressing trade war, the first phase of Sino-U.S. trade deal was signed at the beginning of the year.
So this is a very big day for the United States. It's a very big day for China. This is a day that nobody thought could happen.
Now the agreement is facing a mid-year review.
China and the United States plan to hold delayed trade talks in the near future. The meeting will evaluate progress in a Phase 1 trade deal they signed in January.
The review cannot meaningfully start without referencing the coronavirus pandemic that is still wreaking havoc globally, particularly in the U.S. Nevertheless, it is still important to evaluate the current status of implementation. Are the two sides still honoring the deal as the Sino-U.S. relations deteriorate? First of all, even amid the pandemic and the torrent of anti-China actions emanating from Washington, such as sanctions against Hong Kong and Huawei, and a more recent attempt to ban TikTok, China is still buying and buying big. According to the agreement, China has committed to an additional $63.9 billion of covered goods by the end of this year relative to the 2017 baselines. This implies an overall import target of $172.7 billion in 2020. Based on trade data tracked by the Peterson Institute for International Economics, China's biggest shortfall so far is the energy products. At the end of June, imports had reached $1.3 billion compared to the $25.3 billion targeted for the full year. I'm not concerned about shortfalls in the agricultural and manufactured goods categories. As the economy in China rebounds, a few dozen billion dollars of demand or something the world's largest consumer market can easily digest. Just a few days ago, on July 30th, China made its largest ever purchase of U.S. corn, buying 1.94 million tons at an estimated cost of $300 million on a single day. But the energy category does appear to be a different story for two reasons. One is related to energy products' unique storage capacity problem. China cannot import more if demand has not recovered. The second relates to prices. Remember when this deal was signed in January, oil prices, for example, WTI, West Texas Intermediate, were hovering around $60 a barrel. They crashed to $11 at one point and have since recovered to around $40. That means China has to purchase 50% more volume as the price has dropped by 50%. Year-on-year imports of U.S. liquid natural gas trebled in the first half of the year, but due to the crashing prices of the commodity, the value of the imports only doubled. And there's also the problem of supply, as many shale oil companies in the U.S. have gone belly up. Thankfully, the Sino-U.S. trade deal does have a clause that the two countries consult in event of a natural disaster or other unforeseeable event, which COVID-19 fits perfectly. Therefore, we would expect the two gentlemen to work out something to meet the original schedule.